Hello and welcome to our weekly economic outlook. This is Ahura will be with you to review the week 47 of 2025. As always, first let's check what we had previous week and then we can go forward and check the week ahead. Last week on Wednesday, finally, after 6 weeks, US government shutdown ended. 43 days, the longest in a history. Thursday and Friday at the first and the second days after opening, we couldn't have enough data because of the delay, and White House mentioned that most probably we will not have many of delayed data. However, next week we can probably have the NFP numbers of 2 weeks ago. I mean, the NFP numbers of previous week, previous month, which is supposed to be published at the first week, and probably we can have it in the third week. Let's see. We will talk about that later, about the week ahead. Last week, one of those subjects and those topics that changed the market trends and the market movements, it was central bank, Federal Reserve or US central bank's possible decision. With the speeches that we had, with the ongoing data that we had, considering the data that we had, we can now say what I was telling that in the last months, that most probably we will not have a rate cut in December. I mentioned before as well, if we have the rate cut in October, December's rate cut will be really a big mistake. Now the markets counting more than 55% on holding the current rate and not cutting the rate. This is what we understood from the speeches of the Fed members, as most of them mentioned that the inflation is around 3%, while the GDP is fine, increasing with 3.5 and 4%, between 3.5 and 4% in different surveys in the third quarter, and while the unemployment rate around 4.3% is something normal. I mean, it's around the normal numbers. At the same time, the seasonal, if we look at the data seasonally, those are acceptable numbers, even in low initial jobless claims data. Anyway, these data says that currently, with the ongoing inflation and economic data, if we cut the rates further, it can increase the risk of inflation. That's why the market, as you can see here in CME FedWatch tools, that right now the market is counting on holding the current rates. On the other side, on other data, if we want to say about the data, we started with the Chinese inflation numbers, where we could see inflation in both monthly and annual scales increased only by 0.2% in October. That was the first data from the China, which was somehow good, but later during the week we didn't have good data from China, especially we had just only two positive data. This one, that the inflation, another one unemployment rate, which fell to 5.1%, but other economic data from China, including industrial production, including retail sales, including fixed asset investments, all of them, they showed that the economic growth is weakening at the beginning of the fourth quarter, and that increased again one more time the concerns about the Chinese economy grow for 2025. Can that achieve its goals or not, which is around 5% economic growth. If you remember, I mean, we mentioned in our annual economic outlook, we talked about that around 4.5 to 4.7% economic growth for China. We can read this for the 2025 global economic growth outlook. On other economies in United Kingdom also, we did have a really disappointing numbers, with unemployment rate increasing to 5%, while the average earnings increased much less than expected. That shows that the UK economy really needs the support and help. And then most probably, even in the GDP numbers in the United Kingdom, we had the same negative reactions numbers, and that says that the Bank of England most probably will have the rate cut in its next meeting. In Australia, unemployment rate slightly eased to 4.3% from previous 4.5%, supporting the holding the current rate, most probably in Reserve Bank of Australia's meeting as well. Previous week, we had three reports, monthly reports of the International Energy Administration and OPEC reports as well, and US Information Administration as well. IEA, EIA, and OPEC. All those mentioned reports, they confirmed that the market expecting oversupply, more supply than demand in the market, which was IEA and EIA mentioning about that in the previous two reports as well. But the OPEC was talking about this, like somehow we wouldn't accept that, but now the OPEC also accepted in its economic growth, weaker economic growth, and in less demand than supply. Even though the OPEC Plus, as you know, they already suspended their recovering production plan. I mean, why I'm saying recovering production plan, because in 2022, sorry, or at 2022, doesn't matter. They cut the production by more than 2 million barrels, and now they started in the previous months. They started to recovering this production by 137,000 barrels a month, and now they decided to suspend this overproduction or recovering production plan from in the first quarter of 2026. Even thought that couldn't support the oil price. However, the geopolitical tensions, especially between the Russian and Ukrainian, they increased the tensions in the market and price expectations. That at the end of the week on Friday, also we had U.S. Baker Hughes recounts, and they showed that the overall rigs and rig counts increased in the United States for the gas and oil, both to 417 from previous 114. And that can also, the oil, sorry, and the overall increase to 549 from previous 548. That shows that generally the production probably can be higher. And even in the OPEC Plus, in the EIA reports also, we could see that most probably US will be the production leader for next year. That was what happened overall the previous week, and for the week ahead, most probably, as mentioned, we're going to have the NFP numbers in the United States, but aside that, we will have probably housing that not probably we'll have the housing market data from United States as well, where we are expecting to see slightly better than it. In the better compared with the previous month, better data, and that can support again the idea of holding the current rates. In United States, those numbers will be the most important data. NFP, if published, we are expecting to see the unemployment rate to stay unchanged at 4.3%, with the average income of around 0.3% monthly and 3.8, 3.9% annually. That can support the idea of economy is fine and the labor market is fine, with around 45,000 newly created job for October. That's about the United States. Looking at other data, starting from the Monday next week, we're gonna have the Japanese GDP number for the third quarter, and we are expecting to see the slightly weaker data that support the idea of holding the current rate and not rate hike in Japan. The same idea that Japanese government, the new government, Mr. Keishi's cabinet also is looking for, and that can put more pressure on the Japanese yen against its crosses. In the next week, we're going to have the 2-minute inflation numbers from different economies across the world. In Italy and more other European economies, we're going to have them, especially, but not just European and other, generally the developing and developing economies. In Canada, we expect to see that the inflation increased by 0.2% for the core numbers and 0.1% for the headline, same as the previous months. But The annually also increase inflation should be around 2.8 and 2.4%. We are not expecting any changes, special changes. But however, don't forget that the Bank of Canada cut the rates twice in its previous two meetings by 50 basis points in 2 weeks ago, in two meetings before, and in a previous meeting they cut the rates by 25 basis points, especially after Mr. Trump's tweet on additional 10% in tariffs. That means that the Bank of Canada already cut the rates in past two meetings by 75 basis points, and with this expected inflation, we are not expecting any rate cut at least by year end. Later on Tuesday, we're gonna have ADP numbers, but not many other data. On Wednesday, which is very important day, we will have export import from the Japan, which is again we're expecting to see slightly weaker numbers, and these weaker numbers can put the pressure again on the Japanese yen. Same as the GDP, weaker GDP, expected GDP numbers, that means that the Japanese central bank will not go towards hard hawkish policies for now. CPI or consumer price index numbers also from United Kingdom should be published on Wednesday, where we are expected to see slightly weaker inflation, probably inflation is going to slightly lower, and with only 0.3% monthly growth, which means 0.2%, sorry, monthly growth, or there are some expectation of 0%, but I do expect a 0.2% monthly growth, which means that annually we're going to probably have inflation around 3.5, 3.4%, and for core inflation, and for headline inflation, we're going to have probably about the 3.8%. Producer price index also supposed to be around 3.4%. Generally, the weaker inflation will support the idea of the rate cut for Bank of England for its next meeting. In Eurozone also, we are expecting to see the harmonized price index, the inflation around the Eurozone, also to stay around 2.4% unchanged. House prices and housing starts and building permits and new home sales. Generally, the housing data is we're expecting to see a little bit positive data from United States, as mentioned at the beginning, and that can support the idea most probably of holding the current rates. Initial jobless claims also, as all Thursdays, this Thursday, after finally the government opens, this Thursday finally we're going to have the initial jobless claims, and we're expecting to see around 227,000 application for receiving the unemployment benefits, which means the labor market is fine with the 230,000 applications. There are acceptable numbers for the applications. Yeah, that will be the most important numbers that we're going to have in the economic calendar. Looking at the charts and data, we can say that the market risk, if you look at the VIX chart, we can say that the market risk is still high with the VIX around 20, above 20 actually, we can say. That means that the market risk, when the market risk is high, we will have more demand for safe assets, including US dollar index, and risk asset will get the pressure. Looking at the chart, we can say that the US dollar index, despite the slight easy, backdrop that we had in the previous days, from 100, about 100 to 99.15, still is a positive, and probably we can see the dollar index around 99, slightly higher or lower, but around these levels. And in other markets, gold still trading about 4,000, and we're expecting to see these positive movements to continue as the market's still counting on a higher risk in the ongoing risk in the market. We know that despite even thought that the Republicans and Democrats, they agreed on a reopening, but still there are too many agreements between them, especially now that this just temporary funding, and we can have the government's funding only defunded the government's budget only till January 13, and we can probably have the next month again these tensions will start, and that's why the market risk is still high, and that can affect the GDP growth as well. That's why with the higher risk, still we're gonna have the more demand for the gold, and most probably gold can hold its levels around 4,000. While we are getting closer to the year end, and during year end, many owners, many investors also they are selling their stocks, moving their money towards safe assets, including the gold, to buy the stocks in new year again. We will talk about that later in one another video about educational video post probably. In WTI or energy market, with the lower economic growth expectations that we had in economies and the tensions and the risk in the market, we can see geopolitical, I mean the economic risk in the market. We can see we will have most probably pressure on the oil price, but at the same time, geopolitical tensions is still high, and that can increase the demand of the oil. And so with the higher demand, I mean, that can put not the demand, that can increase the tensions and the risk of production. That can probably just like overcome with the risk and the demand risk and hold the oil price between 50 and $60. We are not expecting to see the oil price to fall sharply under 52 or 53. Most probably we're going to have around these levels. The stock markets, with the ongoing tensions, with this disappointment between the parties in the United States, and with this mindset of many investors and traders that we got up with, most probably the AI stocks, they are overpriced. Even thought is no matter if it's right or not, but the idea of most probably that it's overpriced and saving the profit, that can continue to putting the pressure on the stock markets, and we're expecting to see downtrend to continue in all main stock markets, including Nasdaq, Dow Jones, and S&P 500. In the cryptocurrency market, as the market risk is still high, and many walls they are selling in the money through cryptocurrencies, money flow to cryptocurrencies is lower due to on-chain data. We can see still this pressure on the Bitcoin can continue, even thought it technically also it's in a downtrend at current at 94,000. We expect to see if the downtrend continue at least till $80,000 can continue next weeks. But if the price recover about 102,000, that scenario can be cancelled. Yeah, that's the what happened previous week and what we are expecting to see in the week ahead. Hope it was useful for you. Talk to you again another time. Have a good time.